Good afternoon, team. Welcome back. Today we had a lot of live sessions, so we're very excited to be here again with Ryan. Welcome, Ryan. Thank you for joining.
Thank you, Fabio.
And before we start, let me just put our disclaimer for a few seconds, and then we'll get started. All right. So Ryan, for those, I think you've been with us live a very different occasion, right? But for those maybe you don't know you, see you the first time, maybe if you could maybe just give us like an introduction of you, your experience, what you do while we're working together, and then we can kind of get started. The goal of this session is to show you how to leverage volatility to be able to understand what's going on in the market, and we're going to go out and see few of the new charts that we developed. So we have something here on the screen, and we're going to go into some details, and then we'll open it up for questions.
Yeah, certainly. So my name is Ryan Darnell. I'm the founder and portfolio manager of Cynical Capital, a startup hedge fund that focuses right now on friends and family. And we've just finished our third year of management, and we're going to be looking to scale up here, at the end of this summer. My background, I spent the last 16, 17 years now trading options. I started off at Deutsche Bank in the commodities, energy, agriculture, derivatives, and options trading. And I've traded everything from physical commodities to, financing structures on commodities, and of course, lots and lots of options. In addition to Cynical Capital, I also help advise some smaller commodity derivatives trading businesses, help manage an options book on exotic options as well. So I have a lot of experience looking at different options, as well as, flat price and taking a view on regular futures and stocks and commodities. But options are kind of my passion. So we're starting Volatility Corner, an ongoing series where we will talk every couple of weeks about what's going on in options markets and volatility in the overall markets. We're still going to be figuring this out, so we're open to lots of feedback. We want to make sure we're talking about things that interest you, but I'll try to go through every 2 weeks and hit on the key features for, probably the most important indices, particularly SPX and QQQ. And then if we have time, we may touch on some futures markets, commodities markets, things like gold, crude oil. And we also want to hear from you what stocks or markets, indices, trackers do you want to focus on, and what do you have questions about? We're going to be demoing the relatively new dashboard here that looks pretty slick. And one of the reasons I've worked with MenthorQ for so long here is, one of the challenges I tell people, even for a business, even for a hedge fund, if you're not huge, just getting access to quality data and setting that up is a monumental task. I mean, we've spent a great deal of money and time building out our various screening and data capabilities, and we would be a lot further behind if it wasn't for MenthorQ. So, this is a great tool. It's the same kind of tool that the pros use, and they're upgrading it every day, including with guidance from me on what we like to look at. So without further ado, let's jump in. So I'm going to start with SPX. It's, just kind of the most popular one, I think, to talk about. And I'm going to show you 3 charts that I like to look at, kind of the first place that I would start if I'm trying to understand what's going on in a market and what the options market can tell us. So this is my favorite chart, the smile chart, or smirk. So these are basically what I'd call an implied volatility slice. This is a little bit of a weird chart until you get used to it. But ultimately, what this tells you is what implied volatility is for options at different strikes. So, if at the money is, around here, and you want to buy calls, you're going to be looking at something like implied volatility ranging in this kind of below sub 20% range. And if you start buying way out of the money puts, your implied volatility starts to really scale up. So the first interesting thing I want to point out about this one, for people who haven't seen this chart before, is you can see the puts are a lot more expensive. The out of the money puts are a lot more expensive in volatility terms than the out of the money calls. And what that means is that, for an equidistant from the money call and put, if you sold the put and bought the call, you would actually receive premium for doing that trade. You'd be net getting paid to do that trade. Or if you wanted to do it at zero cost, if you wanted to sell a put and buy a call and have it be premium neutral, not pay or receive premium, you'd be able to sell a put further away than the call. So, just if we were using 5,800 as at the money, then, if you sell the 5,600 put and buy the 6,000 call, you're going to net receive premium for doing that trade, because these puts cost more in implied volatility terms. And just a reminder for anybody who's still trying to get familiar with options, implied volatility is effectively, the key. There's three key drivers for an option, for option price. How close to the money it is, how volatile the underlying is, and how much time you have until expiry. And so whenever in doubt, whenever I'm trying to remember that for our beginners, I just ask myself, if I owned a call option, what would I like to have? I'd like to have the underlying be higher, closer to my strike, or even higher above my strike. I'd like to have more time on my option, and I'd love it if the thing that I have an option on starts moving more. So you can always remember those three. But of course, how much time you have until expiry and the underlying are known. So, those things don't change. We can check them and just know exactly what they are. The implied volatility is the missing piece, and that's what we go to look up on a chart like this. We say, okay, what kind of implied volatility are we at? And we can see here, if we kind of drill down, we're going to be looking at, something like 18%, 18, 19, maybe 20% volatility, depending on what strikes we're looking at, if we're close to the money. So that's the first thing, just kind of walking through what this chart is. Something interesting to look at right here is, so look at how this change in the put wing. It looks like suddenly puts got a lot cheaper, right around the 4,500 to 4,800 strikes, a lot cheaper, at least relative to where they were a month ago. So, I think that's, something interesting to keep an eye on. We can talk more about maybe a trade idea for the week later, but my initial question would be, maybe we should be looking to buy puts somewhere in here and maybe sell a put out here, and maybe we can get a little bit cheaper put spread. If we wanted to buy some protection against a sell-off, often one of the cheaper ways to do that is to buy an option and then sell a further out option to recoup some premium. That's particularly attractive with puts, because you can see how the further out you go, the more expensive they get. So just outright buying puts on the S&P gets pretty expensive. And I guess let me give a little more color of why that is. So one of the things that you'll notice, so one of the things, as we're talking about why puts are more expensive than calls, one of the things that drives that relationship, it's really two things. You have, empirically, like what happens to the market, and then supply and demand. So the first one, supply and demand, should be pretty straightforward. Most people are long stocks. Most people are long the S&P 500. And so given a choice, most people would love to buy protection or insurance on their portfolio selling off. That's, always one of the biggest concerns. And so there's just a lot more demand for puts. And as the market sells off and people start to panic, particularly people who might have leverage or need to get out of positions in a sell-off, they're going to pay even more premium for that. And so they're going to drive demand for options even higher. So that's the supply and demand piece. And then the other piece is empirically what we expect to happen to implied volatility. Well, when does stock markets have big sell-offs? Usually when there's a lot of fear, when there's a panic, big economic crisis, financial, some sort of financial or liquidity crisis. Those are typically the things that cause markets to sell off. And so it's usually volatile as it's selling off because of that panic, because people don't know what's going on. Markets are making big movements each and every day. Whereas when we're rallying, everybody's happy. The VIX is typically falling as the market rallies. You know, while there have been plenty of big up years, when you look historically at the S&P 500, you typically see that up years kind of range in that 15 to 30%, but really, more in the 10 to 20%. And when they move, it tends to be a lot more steady on a daily basis when they rally. Whereas when you look at sell-offs, sell-offs tend to range from 20 to 50%. Not that it's fallen 50% many times, really only a couple examples of that, but we've had quite a few big sell-offs, and when they do sell off, the daily movements have been very volatile. So that's kind of the two reasons that that the SPX looks this way. Now, for an individual stock, you might see things a little bit differently. For example, if you're looking at NVIDIA and they have a big earnings announcement or something coming up, you might actually see a more symmetrical smile. You might see that investors are about as equally concerned about a massive, or options markets are as concerned about a massive gap higher as they are lower. So that's not uncommon for single stocks to have a more symmetrical smile around at the money. And then, but at the market level, as you start to diversify, when everything starts to go crazy, and correlations tend to go to 1 in a major sell-off, meaning that you'll see all the stocks sell off at once, not just a few. So that's why you can see a lot of single stocks that are fairly symmetrical or even biased towards the upside, because investors are paying a premium for calls for that single stock, but almost never see that. I'm not sure if there's ever been a period actually where puts have been at a significant premium over calls. So that's quick overview of the volatility smile, and I love this because it's easy to just get a quick snapshot and understand a little bit more about that market. Interestingly, we have a few markets that are the opposite of SPX. One that I wanted to call out today, we don't have the volatility smile on this, but I wanted to call out the corn market because we've seen something interesting going on in corn. Typically, corn is the opposite. And I'm always partial to corn because I started out as an agricultural derivatives trader. So typically what we would see with commodities markets, and here's the corn futures curve. Typically what we would see is when prices are rallying, that's actually when it gets really volatile. And the reason for that is when you look at things like corn, wheat, soybeans, things get really crazy when there's a shortage. You have a drought, farmers can't get the crop planted because of a late freeze or flooding in the fields. It's usually some sort of extreme weather event, and that'll significantly reduce acreage or yields. And when we get that, so usually you'll see this kind of hit to yields, and that leads to a big price rally. Prices take off higher. And when that happens, things get scary. Additionally, in the futures markets, where I was saying, for the S&P 500, most people are long stocks, in your 401k, whatever. People are long asset managers. Everybody's typically long stocks because over the long run, we expect a positive return on stocks somewhere between, 8 and 12 or 13%, depending on what historical time scale you're using. So everybody's long. Well, we have the opposite scenario in corn. So most commodity buyers will buy the corn and hedge themselves by selling futures. And they actually have to post margin on the futures exchange if the market rallies. And so they're often buying calls to protect against a massive market rally that'll require them to make a huge cash deposit on the exchange, which they may not have to the CME, and they may not have the liquidity to do that. So we see the exact opposite. We see the supply and demand is that, so first supply, we talked about SPX, the supply and demand, people want to buy portfolio insurance. In the corn market, we see the exact opposite because people want to buy calls to protect against markets going bananas. Also, farmers don't buy puts because they get revenue insurance that's subsidized by the government. And so that also makes them not really as worried about buying puts. And then we said empirically, that's the other thing that drives the volatility smile is when you see, in the SPX example, we talked about how as prices are falling, there's a panic. So daily moves get quite large. In corn, it's the opposite. There's a panic because there's a drought. So daily moves get quite large as you're rallying. But the reason I called out corn today, we're going to jump around every 2 weeks and talk about something interesting going on in markets, is corn is lower and volatility is going up. So you'll see here that over the last month, we've fallen dramatically here. We've fallen about 10%. Pretty sizable move here, particularly in the front of the curve. In futures markets, so that these are the short dated futures contracts for delivery in like March and May and July, March, May, July, September. And when there's a lot of concern that there's not enough to go around, you'll see those go to a big premium over later months. And the reason for that is because, especially in agriculture, is that there'll be a new harvest, a new crop coming around this harvest time. For corn in particular is September, October, November is the harvest. So futures prices out there aren't so crazy, but as people get concerned about tight supply, they push this to a big premium. We call that backwardation, and you'll see this in any futures market. So anytime we're talking about gold, crude oil, or agricultural commodities, this can come up. So this is a way that the market rations demand. It's pretty cool. You see a big premium in the front versus the back, and that encourages buyers, consumers, if they can, to delay their purchases so they can get a big discount. Look how much that's declined. So look at the green curve here over the last month. So we've had this 10% decline in the front, much less than the back, and now the front and the back are almost equal. The curve's much flatter than it was just a month ago. So you'd expect, okay, people aren't scared anymore, so vol should be going down, and it's not. I don't have the historical chart today of implied volatility, but we've actually seen implied volatility go up 3 or 4% for corn. And reason, trade war, tariffs, and embargoes, fears around that. So we're having markets sell off as there's an expectation we're going to export less. We're going to export less grain, and a lot of concern over what will the follow-up be. It's very likely that another country will slap tariffs on us, and one of our biggest exports is grain. So we're actually seeing the opposite here. We're seeing volatility spike while markets sell off, and I'm sure, and I'm sure, in fact, I can even say for some of the books that I help with, we're seeing this as a surprise for market makers too, who might have been short volatility to the downside, and that's not happening right now. We're actually seeing volatility pick up. So the big question will be, can volatility stay high, 23, 24, 25%? For corn, while prices stay relatively low, down here around the kind of low to mid 4s, without more demand scare. So that's going to be the thing to keep your eyes on for anybody who's interested in agricultural markets. Is does this can volatility stay high while prices stay low? That would be pretty unusual, like the equivalent of if the S&P was going up every day, but people were panicking, and it was having big up days, big down days, but on average going higher. Real quick, I'll pause and take a few questions.
Yeah, I think we have a question from Dan. I don't know if you can see it, Ryan. So,
so it doesn't necessarily mean. So the question is, can we infer that people are buying puts? I would say it doesn't necessarily mean. I mean, they have some other nice charts on here, and I'm still familiarizing myself with some of these new features. So as we get familiar with new features, we'll look at them, explore them together. I'm pretty sure there's a ratio here of put to call open interest. I don't know if Fabio wants to remind me where to find that, but it's not necessary that there will be more puts owned than calls. But the key here is more people would definitely buy puts if they were priced with the same implied volatility. If there wasn't a premium, if the puts weren't more expensive, then people would start buying them. We can be very confident about that. And so that pushes the price higher. Now, market makers move their price for puts higher And so at any given time, people may actually say, no thanks, like it's too expensive to buy puts. And so there may actually be more open interest in calls, because, the put premium is sufficiently high. So I would have to, we'd have to check, and I'm not an expert on SPX options. That's not where I spent most of my career, although we do actively use them for my fund. But, I couldn't tell you off the top of my head, like, what the ratio of open interest is. So we'd have to go check that. And that will definitely swing based on individual market conditions. So you could see you could see the market leaning extra long puts or significantly less long puts, and it wouldn't be surprising at all if there was more open interest in calls than puts. But again, the key there is that's because market makers aren't dumb, right? Like, they don't sell options too cheap. They know that there should be this premium for puts. So, they build that in, whether those puts are getting bought or not. Which now, if the premium was so high that a lot of people came in actually selling puts, they could push that put skew down. Hopefully that answers your question. So real quick here, we'll just look at a couple other charts here on SPX. Let's check a few other commodity futures while we're here and we're familiar looking at it, and then we'll go back through our rundown of the equity options markets. Let's see here. So let's get gold futures up. Notice that looks like we might have a bug here that's sticking on corn. Here we go. Oh, I see here. Hold on. Maybe we just need to click on crude oil futures.
What are you looking for?
It looks like the futures price curve is still showing corn.
Okay.
But we switched over to crude oil here.
Yeah, maybe just refresh. Let me see.
Let's try that and see if that gets it going for us. There we go. All right, just need a hard refresh. All right, cool. So then, let's look at while we're talking commodities and people are interested, you'll notice the crude oil curve is much smoother than the corn curve we looked at. The reason for that is crude oil doesn't have a seasonal. You don't have this kind of weird phenomenon where, there's like a big harvest. And so you'll get this kind of like lower point on the futures curve. You see this much smoother, but we're seeing with crude oil the same thing that we were seeing with corn, which is that short-term demand is still pretty high, and the crude oil market is still trying to ration demand, pushing consumption further out. Crude oil, though, it's worth mentioning, is far more like the S&P 500. Crude oil has a positive put skew, meaning implied volatility for puts is significantly higher than for calls. And the reason for that is because crude oil is so heavily correlated with the economy. So it has a lot of overlap with the S&P 500. And there's definitely some funds and people out there who will try to trade trade crude oil against the S&P 500 or consider that, because the biggest driver of crude oil supply grows fairly steadily, whereas demand is quite volatile. The biggest thing that happens when you have an economic recession is that people start buying less stuff, they start traveling less, so a lot less fuel is used, both in cars and planes, and then a lot less trucking fuel is used. Additionally, it slows down development in the developing world, and they're a lot of the source of kind of marginal demand, growth in demand. So when that demand doesn't materialize, that's going to drive crude prices lower. So as people are afraid, like they are right now in the, people are nervous right now across the board. We're seeing treasuries higher, treasury yields lower, S&P 500 falling pretty aggressively, and crude falling. And that's going to be because of concerns for economic demand and potential trade war, similar to corn. But The difference is in crude oil, we would absolutely expect volatility, implied volatility, to go up and be particularly firm as we're selling off because people are pretty nervous. But the big key here is to point out how nice and smooth that curve is. But the same thing is happening. It's rationing short-term demand. So people are more scared about a decline in demand in the future. But current spot demand is still decently strong. And for that to change, we'll actually need, and for spot prices to become lower than futures prices, then we'll need actual low demand to materialize. And we'll try gold as well, just again, sticking with this trend, just so people can get a sense in how the different commodity curves behave. Let's see here, let's give it a refresh. Again, right now, today's, and probably for the first couple of these, we're going to spend more time talking about what we like to look at, what's interesting, how we think about different things, commodity. And then as we pick up steam here in the coming months, we'll get into the habit of going over, just focusing on what's really interesting. And as we develop kind of some long-term followers and fans of this segment, we'll just focus on their questions more and more here. Okay, so gold, you'll notice that gold has the exact opposite behavior and opposite, an opposite structure of crude oil and corn. So first off, you'll notice that the prompt months, the spot months, the short dated months are much cheaper than the back. And the other, so that's the one interesting thing. And then gold also is going to have a skew that's similar to corn. Typically when things get crazy, gold prices are going to go up and get crazier because it's kind of considered a hedge, a safe haven asset for people who are getting out of other commodities. So whereas we saw that, the blue line 1 month ago was significantly higher for corn and crude oil, and of course for the S&P 500, if we're looking at S&P futures, we're seeing the opposite here. We're seeing that gold has spiked as people get scared, flee to safe haven assets, and but interestingly, the front of the curve doesn't go up, and that's kind of unique to gold. The reason for that is that this upward sloping curve structure, we call this contango. And that basically incentivizes people to store it for the future. And the reason for that is because we have a huge supply of gold above ground and in storage, like massive compared to how much is actually needed at any given time. Because people hold gold as an asset for safety. Central banks hold gold. Individuals hold gold for decoration, for and jewelry. They hold it for a hedge, as an investment, and so people are just holding tons and tons of gold, whereas industrial demand for gold is actually quite low compared to something like platinum or palladium or silver, where you've got a decent industrial demand base. So the gold curve pretty much always looks like this, and that's basically incentivizing people to store gold because basically the slope of this curve helps compensate them for the amount of money that they lose on storage by holding gold and waiting for a time when there's industrial demand. So that's enough about futures for today, but hopefully that was interesting for everybody. Now we'll jump back into the S&P. Finish our review of the S&P and then check out QQQ, and then we'll focus on any individual tickers or assets that people have questions about. So in this volatility smile that we spent a lot of time talking about, we can see we can see here inherently that people pay more for puts than they do for calls. But another useful way to track this is to say, well, how is that evolving? Granted, we know that puts are more expensive than calls, but the question came, well, does that mean that people are really long puts? all the time. And that's a fluid thing. So we can actually track this premium of the puts over the calls over time historically. And so, what we can see here, so what we can see here is this white line, which shows over the last 30 days how those puts have, how much of a premium they've had over calls. And you can see, at least today, not a big move from the standard. There's a gradual trend higher here. You can see over the last 30 days, puts are definitely inching higher. I think we've gone up to 45% versus 40, and that's measured as a percentage of at the money vol. People like to look at this different ways. Personally, I usually just look at pick a certain point on the curve. In this example, they're using the 25 delta risk reversal. For people who aren't familiar with that, that's basically just saying getting a put and a call. If we take a put and a call that are equally likely to be exercised, so instead of just doing for the same strike or for the same distance. So let's say that, again, S&P is, for easy rounding, at 5,800. Rather than say just picking the 6,000 and the 5,600, we'll go find a put and a call strike that have a roughly 25% chance of ending up in the money and compare those two. And that kind of adjusts for the fact that there can be skew, and it adjusts for the fact that which strikes we look at will change over time as we get closer to expiry. A lot of technical details, which I can talk about more in kind of advanced options classes, which I'll be teaching more of here in the coming months as well. But the basic idea here is, so when we say 25 delta risk reversal, we're talking about just an equally far apart call and put. And you can think of that, an easy way to think of that. That's not exactly how the math works, but that means it's got roughly a 25% chance of finishing in the money. And if we said the 10 delta risk reversal, that means we'd be looking at the comparison between pretty far out of the money puts and calls, only about a 10% chance of getting there. 25% is kind of, reasonable. And obviously we're about 50% if we're looking at the money. So real quick, going back to, if we're looking at this smile, this is going to be right around here, is going to be right around 50%, because it's as likely to go up as it is to go down. If we're saying 25 deltas, we're probably looking, somewhere around here. And then when you start talking 10 deltas, you start getting way lower probability events, and even the 1 deltas. And probably one other thing we should mention is, if you ever look at very low delta options, what options traders call teenies or lottery tickets, it's worth noting you'll always see, as you go really far away, even for the calls, this isn't on here, but this will actually turn up really steeply as well. As you get sufficiently far from the money, the implied volatility will go towards infinity. And the reason for that is because at the end of the day, people aren't stupid. And even if the probability of an option being executed is basically zero, someone's not going to sell it to you for free. And so what happens is, if someone's not going to sell something for less than a point, then the implied volatility has to go to infinity, because that's just kind of an oddity of the model. But that's so you'll always see, if you look at a wide enough scale of strikes, you'll always see, and there's a price available, you'll see that the implied volatility goes towards infinity. And again, that's because people won't sell you something, no matter how unlikely, for nothing, because those options, fair price is zero, but you're not going to get it for zero. So just something to be aware of. So back to the 3-month skew. So we can see there's not a lot going on here, other than you can see the steady fear that's been creeping into the market. You can almost feel the nerves as we have been, which I think everybody here who's a regular market watcher is aware, that whether it's 10-year treasuries or stocks, it's just the increasing fear has been weighing in. And you can see that in this yellow line that's just slowly being dragged higher from 40% to 45%. For a while there, it looks like puts got quite cheap, actually. And if you were lucky enough to buy puts a few days ago, good on you. But now we're seeing a pretty big premium for puts. This is puts minus calls, so it's also possible that the calls declined a lot. Okay, here. Let's try. And then this is term structure. We've talked about this once before. So basically, the term structure tells you, how people are feeling about implied volatility. So short-term implied volatility, surprise, surprise, very high. People are nervous right now. They're nervous about the stock market does not like uncertainty, and Trump brings a lot of uncertainty. Will there be tariffs? Won't there be tariffs? What will happen with immigration? What's going to happen with prices? How's the Fed going to respond? There's just quite a lot of implied volatility short term. So that's putting a big premium on short-dated options. Now, of course, you can see that this fades out pretty quickly here. And so people think volatility is, this is telling you that the market thinks that implied volatility is going to return to more normal levels. And I don't think it's going to take that long either. We are up here. So, it looks like, let's see, 1 month ago. So volatility was below 15% for the S&P 500 about a month ago. And we've had a pretty steady boost all the way out, going out for the next 3 months. So, people think that extra 5% or so of daily realized, and that's an annualized number. So you can actually calculate the break even. You can actually, if people aren't aware of this, you can actually take at the money volatility and you can estimate how much people are going to, or how much the market's pricing in a daily move in the market. So you can actually take, so if you take, and we can post this formula later, but if you take the underlying price, so again, we'll just roughly say 5,800, and you multiply by the implied volatility. So in this case, let's say 60-day, let's just say 40-day volatility of 20%. So times 0.2, 5,800 times 0.2. And then we can, that's the annualized move. But if you want to see the daily move, which is a little more useful because options markets, they don't really necessarily mean that the market is going to move that much over a year. It's more based on how much options market makers are going to have to make or lose hedging their options daily. So really the daily number to look at. So we take that 20% of 5,800, which is 1160, and we divide that by the square root of 252. That's just the number of trading days. So if there's 252 trading days, we take the square root of that because options have a nonlinear effect in time. So if it's about 15.8. So you can divide by 15.8 and you get 73 points. So that's pricing in right now over the next 40 days that the S&P 500 ought to move about 73 points a day to cover your options break even. That's kind of the, if you're an options buyer and you choose to delta hedge, which, most retail buyers don't, but, you'd need to, the underlying the S&P to move about 73 points a day. So if you're running a strategy where you're, setting your stop outs or whatever, if you're setting them under 73, you better figure there's a pretty good shot you're going to be getting stopped out quite regularly here.
And if I can add something, Ryan, one thing that we can also look for is if we look at the matrix, we also have the expected move of the expiration. So for those who are looking at, 20 days in the future, so expiration of April, for example, you can come here and you can see like the expected move up or down here. So this is kind of using our proprietary models. So it's basically telling you that the price could move 277 points by April by looking at the option data. So this is
I'm glad you brought that up, Fabio, because as we get into, as we get more advanced, as we move through every couple of weeks, one of the things we're going to start to look at is the proprietary models that they've developed here. And I think they're pretty neat, and how their expected move differs from maybe what the market's pricing in. And that tells us, hey, maybe there's an arbitrage opportunity here. I mean, not a true arbitrage, but, a great trading opportunity. If it looks like, according to our our models, these proprietary models, it looks like the market's not expecting to go up by 78 points or whatever it is, but the options market is pricing in 78 points. Oh, he's saying can't see your charts. Screen is blank.
Maybe it's an issue with the stream. Not sure.
Huh, weird. Can everyone see us again?
Yeah, maybe try and refresh in the link. Not you, like.
Oh yeah, maybe our user should refresh here. So that's a great point that you know, we want to start showing you know, basically what these different models think the break even is versus the projected break even in the options market. And for what it's worth, we're not actually showing anything right now, just having a conversation here at the moment while we try to figure out what's going on there. Maybe Fabio can see if it's something we can adjust.
Let us know if you have any issues, but I think you should be able.
Yeah, I'm seeing it fine, and I'm seeing my mouse and cursor moving. But anyhow, so not showing anything right now. What Fabio was showing before was that MenthorQ's got some really cool. Oh, good to hear. MenthorQ's got some really cool proprietary models here. If you can see those, that show you, you know, their expectations or our expectations, you know, based on some more advanced data of how much the market's likely to move in a day. And, you know, if one of those models is saying, hey, we think the market's only likely to move 50 points, and the options market is pricing in, say, 73 or 78 points, hey, it could be a good time to sell options. So that's, you know, that's going to be when we start to talk about like trade ideas of the week, flavors that, you know, things that are looking kind of exciting and interesting. That's going to be one of the big topics is, you know, how do the break evens compare? Let me address a few questions here. Let me pause. I'm getting a few. So let's see. First, I want to hit on what are the elements that the market makers look at or follow the most to move the futures market for the future contract. To be honest with you, market makers don't really. I think one kind of common misconception is that market makers move the market. Really, what market makers do is they kind of work bids and offers, and you know, they create a bid and ask based around what they think fair value is. For the S&P futures contract, that's basically a function of where they think they could hedge S&P with, if they need to hedge with the underlying, the S&P 500, you know, cash, either buying the ETF or basket of stocks or different futures contract. You know, a market maker is always looking at what their best hedge is. So if someone sells them futures, then they need to try and buy something. They could buy another futures contract, a further dated futures contract. They could buy, you know, SPY. They could buy a basket of stocks. They could buy QQQ. There's a lot of different options, and every market maker is going to have their own proprietary models, but they're not going to set the price. Really, what they're going to do is say, okay, based off of where I can hedge, depending on what my preferred hedge is, you know, I'm willing to buy SPX futures here and, you know, here and sell here. And if people keep buying, you know, from them, their offers keep getting lifted, then they're just going to naturally, their algorithms are going to just naturally move their offer higher as they're buying other things to hedge. And so market makers tend to move much more organically than you might think. So if people are buying a lot from them and they're getting short, they're going to just naturally move higher. And as all the different market makers are getting short, they move their price up. So it's more responsive to what you know, retail or what we call like natural flow or supply and demand is doing than the market maker kind of setting it. Now, market makers do have fair value models. So if they anticipate a change in flow, they'll move it. So for example, you know, let's say a market maker's got their bid and their ask, right? And then on the S&P 500, or let's say on NVIDIA, and then suddenly like earnings announcement comes up, they're not going to just keep their, and it's really positive. They're not going to just keep their ask price fixed. they're going to estimate, all right, we think that given big enough, given earnings, like, the bid ask should just jump higher. So they'll immediately move it higher, and maybe they overestimate and people start selling. And so then it actually kind of works its way back. But they're always going to have this idea, they're always feeling out the market, organically based on where they can hedge and if they're getting full. Because market makers' goal is to not end up with too big of a position, long or short. So they try to search for the place to balance, that'll balance out, supply and demand. I mean, that's ultimately the service that we provide as market makers. So I'd say that in terms of what are the elements that they look at, it's always their best hedge. So it's going to depend what they're making a market on. If you're making a market on a single stock, you're probably going to be looking at hedging based off of, like a basket of stocks that's related, maybe the sector ETF or maybe just the S&P 500. If you're making a market on the S&P 500, as I mentioned, you'll be looking at cash and futures to find your best hedges, as well as some other things. And then there's also market makers who look at more global macro views. So they might be looking at crude oil and SPX and all these other things. So it really is pretty dependent on the market maker, I would say. Let's see, next question here. So how do you look at the 10-year treasury yield in your analysis? I mean, it really depends what I'm analyzing. I'd say, for most options markets, most of the liquid options are less than a year. So to the degree that interest rates plays into options, not really. You care a lot more about short-term rates. But obviously the 10-year treasury is also a good benchmark of fear. And there can be a lot of trading opportunities, I think, like, hey, puts are getting expensive, but 10-year treasury yields have been fairly stable. Could there be an opportunity? Maybe you want to buy the 10-year treasury and sell put options on the S&P 500 as an example. So I would say if you're worried about your tail risk, that's absolutely something you want to look at, because the 10-year treasury yield is a great barometer of fear. But it's not going to directly impact a lot of options pricing and analysis. It's going to be far more if you're thinking about like where to place your trade, or if there's a trade opportunity at all, at least for me. How can I use MenthorQ tools to anticipate the direction and the size of the daily candle?
Yeah, Dan, I sent you over a link to our academy. So there's a lot of tools that you can use, first starting from our gamma levels. So if you just create a free account and basically come under our academy, and basically you have a lot of information here. So if you start from the free courses, I would start with our gamma levels, which is here. And then we also have all the different models. And then you have a course about trading with MenthorQ, where we bring on a lot of different types of trader experiences and the use cases. So just go through that. You can create an account simply by going to MenthorQ/free, and all these courses will be available to you.
Great. So yeah, I saw a few questions related to that, and as I said, we're going to explore that in this session. I mean, we're going to run out of time today, but the goal is every 2 weeks to kind of take this to the next level. So first, we'll start off by talking about, hey, what is the smile? How is it useful? And we'll try to introduce a new MenthorQ tool and say, great, like how can we combine all this to come up with the trade idea? So we'll start to get into those in future weeks. We're not going to have time to get into all that today. I'm going to hit on a few, but to start with, absolutely use those, the videos, the academy, and there'll be some private classes, I believe, as well, that Fabi and I have talked about. And to be honest with you, there's going to be still some stuff that I'm getting used to, because there's a lot of new features and functionality that have come out that are really great. So we'll also have to prep on our end, because it's pretty exciting, all the things that MenthorQ is rolling out here in this new dashboard. It's pretty slick. And I think a big upgrade over the Discord. So very excited about that. I had a quick question about how a short squeeze will happen in the market. I think it's important to talk about like where the where the short squeeze is actually coming from. Here, I was, that question, Fabio, I was kind of saying that's the stuff I don't think we'll have to get into examples of that, but that would be, your point. Like, check out the Academy, and in 2 weeks we'll go through those. Some more examples of MenthorQ tools. In terms of short squeezes, I think short squeezes are interesting, and you can sometimes see those in the smile if a kink happens. So you can kind of see it's very possible, for example, that this was a short squeeze, or that this is a short squeeze, that someone was long a lot of puts and had to get out. It's always tough to say, because there can also just be a little bit of bad data from the exchange. Sometimes these things get illiquid, so it's hard to know. As we move forward, we'll get more data, and we'll start looking at things like open interest and change in open interest over time. Oh, it looks like I'm just looking at the volatility smile. Going back to when we talked about the S&P 500, back at the beginning of, it says I'm not sharing my screen.
Yeah, it's should be. Can you guys see the smile?
Thanks. Yeah, there seems to be something when we switch. Fabio and I have been switching who's sharing, so maybe that.
Let me see.
It's a little weird here. Let me try one more time, stop and restart, see if that helps. There we go. Got the S&P back up again.
Let me see.
If it takes a minute on StreamYard.
Okay, I think we're back.
Cool. So real quick, so closing out the thought on, so what I was mentioning about potential short squeezes is when you see a big move in this, a kink, it's very possible someone's getting stopped out of a particular strike. So maybe something like the 4,500 put, maybe it rallied last week or a month ago because someone was getting stopped out, or maybe it's maybe it's sold off here because somebody was really long and is puking out of the position. At the end of the day, short squeezes mean different things, but it always, they're very different in, say, a commodity market versus, like a S&P 500 options market. You get very different things. But I'd say market makers have less power than people think. Usually it's the market maker who's getting squeezed out. Not always, but, so usually, like, let's just use an example. So, if it starts, because option, market makers have limits too. Option market makers don't have infinite capital. So let's just say hypothetically that, a few weeks ago, there was a month ago, there was huge demand for this like 4,500 put on SPX, and you sold, there was tons of selling of that, and you were buying it, and you were buying it, and you were buying it. People selling the 4,500 put. At some point, you can only buy so much, and if all the market makers have bought way more of the 4,500 put than they were planning on, because some big mega hedge fund is selling it, they start to get nervous because they can't sell that thing anymore. And so, if one of them hits their risk limits, they're not any more mystical than you or I. They have a boss, and if their boss says, "Hey, you've got too much exposure," they have to start selling out of this. And guess what? All the other market makers are along too, and so they'll start selling this. And so you could see a kink like this develop to the downside because someone's getting out. Again, I don't want to say that this is an example of a short covering rally. This is a smaller move. This could be just due to bad data. And in coming weeks, we'll try to explore things like, do we see a big change in open interest, or one of the MenthorQ kind of like open interest based models around a move in the smile, in the curvature, because we can't know what market makers or market participants are doing by looking at any single chart, but we can start to tell a story. If we look at 3 or 4 different charts and they're all kind of moving the same way. So like if we're like, is this bad data? Is this because it's an illiquid option? Then we go look and we see, wait a minute, actually the open interest in this in this option, the 4,500 put increased a lot. Okay, sounds like maybe what's happened is a bunch of put selling has come into the market. Going to be hard right away to figure out, who did that. But again, we can start to look at the story. We can try to figure out on what date that was happening, and see if there was a particular market move that drove it. So those are the things when we start to look at flavors of the week. Let me see. I think we had a few other questions here. Okay, so last thing on the short squeezes. Sometimes you just don't have enough of a commodity, and people have sold futures and they just can't get it. And same thing with like shorts in the equities market. There's a limited amount of how much is available to borrow, and so if people have shorted the stock and they just literally can't buy it back, no one's really making that happen. It's just a supply and demand. The shorts, shorts have to buy the stock back. They don't have a choice, and there's just not enough of the stock to be bought back. You tend not to get squeezes, like long squeezes, because people who are long can usually just sell it to somebody else. Okay, so let me check here. Zero DTEs. I will confess I'm not really a big guy on the zero DTEs. I tend to focus on 3 months and longer. I will be getting more into that with all of you, and we'll look at them together, I think, as we get questions. I will make some notes to study, if not for the next session, for the one after that. But to date, I don't trade enough zero DTEs to have a view. And I'll tell you, most market makers stay away from those things. They're obviously making markets now, but it's a fairly recent innovation that's gotten a lot of retail demand. So I would say that that's more of a retail trade. Usually from a hedge fund perspective, if we're looking to take a view, it's not going to be using the zero DTEs. We're typically going to be looking at least 30 days out on options. But I think we should all explore those. They're relatively new markets, and again, relatively speaking. So there's going to be a lot of exciting stuff to study. What are your thoughts about a long vertical spread versus a long broken wing butterfly? So buying the call spread, or I assume a put spread. Not familiar with the broken wing fly. Might have to add some details about that. But I'd say that everything, there's an old saying that every trade's a winner and every trade's a loser. It's all about timing and relative, like how much you're paying or receiving to get into the trade. So let's just think of a vertical spread here. Let's think about the put spread. So a vertical spread, for anybody who's not aware, is like you buy a put and then you sell a put with a lower strike. So like buying the 5,000, 4,500 put spread, or you could sell it. You could do the reverse, or on the call side, you could buy the 6,000, 6,200 call spread. It's just a way of cheapening up the premium if you're the option buyer. And if you're the option seller, vertical spreads are really nice because they cap your potential loss. And I'll tell you that for my fund, when we sell options, we almost always sell the vertical spread, or, and I can't recommend that enough. Like a quick pause, a little aside, a lot of retail players that sell options, if you have a strategy, stick with it. But my personal recommendation is when things get crazy, oftentimes they get crazy in a way that we haven't seen in 10, 15, 20 years. And you don't want to give back 10 or 20 years of your strategy's profits all in a day. My personal recommendation, ones that I make to my friends who sell options, are, do the vertical spread. Buy the, if you're selling the put, buy a lower strike put. If you're selling the call, buy a higher strike call. Yeah, you'll give up some of your profit, but you'll live to fight another day, because you can say, hey, the maximum I'm going to lose on this trade is, X points or Y dollars. Those are great things. It's great to have that surety. And when I sell money for my fund, because I'm managing other people's money, we can't take the risk of an unlimited loss, no matter how, no matter how unlikely that is. Again, last question, Dan, we're going to look at those things over time. It's going to be stuff we all explore together, including some of the zero DTE. So I think we're out of time now, but thank you everyone for joining. The questions are fantastic. And as we get better at this, as we all get more fluent in the same language here, and and I get more comfortable with the dashboard as well, we're going to keep diving deeper and deeper, and we'll make it more and more about your questions. But awesome questions. This was a lot of fun. I look forward to doing this every 2 weeks going forward, and I hope people will join me again at the Volatility Corner.
Thank you, Ryan, and thank you, guys. So for those who want to learn more about us, just go to our website. If you want to access our free academy, our courses and stuff, you can sign up for free. And then if you have any questions on what we touched today, just send us an email, info@mentorq.com. So hope to see you guys in the premium. And if you want to get access to the dashboard, you can also sign up for our membership. And we are having a promotion now, so feel free to join and access all the nice data that Ryan showed you. And then in 2 weeks, we're going to be back talking about more volatility and more things around option and volatility. So very excited about that. And thank you, guys. See you guys soon. Thank you, Ryan.
Thank you all.